Welcome to Iron Financial, the place where we help you forge a stronger, more resilient portfolio. I'm your lead analyst. Today, we are putting analog devices under the microscope. Look, the stock went on an absolute tear after they dropped a quarterly report that didn't just beat expectations, it completely shattered them. All the headlines are screaming blowout quarter. But you know us here at Iron Financial, we don't chase headlines, we dig into the foundation. So the big question on the table today is this: is ADI a legitimate financial fortress built on a bedrock of real fundamental strength? Or is it just a pretty facade with some dangerous cracks hiding just below the surface? Let's get into it. 30%. Just look at that number. This is what sent Wall Street into a frenzy. We're talking about a 30% year-over-year revenue growth for analog devices in their first quarter. Now, let's be crystal clear. For a mature, multi-billion-dollar semiconductor giant, that kind of growth is almost unheard of. It's like turning a battleship on a dime. They jumped from $2.4 billion to over $3.1 billion in revenue in just 12 months. A number that big isn't just noise, it's a massive signal. It screams that demand is through the roof and that their execution is nearly flawless. But, and this is a big but, a single number, no matter how shiny it is, never tells the whole story. It can be a siren song, luring you onto the rocks. So we have to ask the tough questions. Where exactly is this growth coming from? And the billion-dollar question, is it sustainable? All right, here's our game plan for today's analysis. First, we're going to inspect the walls of what we're calling ADI's financial fortress. We'll break down those incredible headline numbers. Then we'll pop the hood and identify the specific engines that are forging all this growth. After that, I'm bringing in our market skeptic. His job? To search for any cracks in the armor. From there, we'll stress test the very foundation of this company, the shareholder bedrock. And finally, after weighing all the evidence, we will deliver the verdict. We're going to figure out if this structure is truly built to last. Okay, let's start with that surface level strength. When you just glance at the Q1 results, it is impossible not to be impressed. We're in a market that's filled with uncertainty, right? And yet Analog Devices has managed to build what looks like an absolutely impenetrable financial fortress. The numbers they put on the board aren't just good, they are dominant. This is the kind of performance that really separates the true leaders from the rest of the pack, especially when the economic backdrop is as tricky as it is right now. This is where quality really shines through. Now, look closely at this table, because this is where things get really interesting. This shows the incredible operational leverage this company has. It's what separates the heavyweights from the amateurs in the semiconductor space. Yeah, that 30% revenue growth is fantastic, we've covered that. But look deeper. Gross margin didn't just keep pace, it blew past it, jumping 43%. What that means is for every new dollar of sales they bring in, an even bigger chunk of it is dropping straight to the bottom line as pure profit. But the real story here, the number that truly shows you the sheer power of their business model, is the operating income. It didn't just grow, it more than doubled, a 103% increase. This isn't just growth, people. This is an explosion in profitability. It's proof that as this company scales up, its costs are not scaling with it. That is the hallmark of a high-quality, high-leverage business that can basically print money when demand is this strong. So the big question is, where is all this firepower coming from? A 103% jump in operating income doesn't just happen by magic. It's a direct result of specific parts of the business doing some incredibly heavy lifting. So let's get our hands dirty. We need to open up the hood of this machine and see exactly which engines are running red hot to produce these kinds of insane results. Let's break it down segment by segment. This chart gives you a fantastic snapshot of the core ADI machine. First thing you notice is that the business is really well diversified across 4 huge end markets, and that gives it a nice layer of stability. But there's no question what the bedrock is, the industrial segment. It's nearly half of all their revenue at 47%. This is their fortress. It's steady, it's massive, and it supplies mission-critical parts for everything you can imagine: factory automation, robotics, medical scanners, the energy grid. Then you have automotive, another massive piece of the puzzle, at a full quarter of the business. It's powering everything from your car's touchscreen to the advanced safety systems that keep you on the road. But while this diversification provides a really stable base, the real growth story is hiding in the year-over-year numbers. And here we go. Just look at these numbers. That huge industrial core, that 47% chunk of the pie, it's not some slow-moving giant. No way. It grew by a staggering 38% year-over-year. That is absolutely incredible strength from their biggest and most important segment. But the true standout, the engine that is just breathing fire right now, is communications, a 63% year-over-year explosion. Let me be clear, this isn't just some easy comparison to a weak quarter last year. This is a secular tidal wave, and it's being driven by something we are all talking about every single day. And here's the smoking gun, straight from the CFO's mouth. That 63% explosion in communications, it's being powered by record orders for our data center segment. You know what that means. This is the AI gold rush showing up right here in Analog Devices numbers. They are a classic picks and shovels play. While everyone is out there debating which AI software company is going to win the war, ADI is quietly selling the critical components needed to build the infrastructure for all of them. The massive build-out of AI data centers requires the exact kind of high-performance tech that ADI specializes in. They bridge the digital world of AI processors with the physical world of power and data. This isn't some story about future potential. It's happening right now, and it is fueling absolutely massive growth.
All right, I'm cutting in here. The lead analyst has painted a very, very compelling picture of an impenetrable fortress. And look, those growth numbers, especially in comms and industrial, they're undeniable, they're powerful. But this is Iron Financial. We don't just stand back and admire the shiny exterior. Our job is to get up close and inspect that foundation for cracks. Every single bull story has a counter-argument, and it's our job to find it. That fortress might look strong from a distance, but when you get up close, you often find potential weaknesses that the market, in all its excitement, is totally overlooking. So let's start digging.
And this, right here, is the first major red flag. This one little sentence, almost an afterthought buried deep in the earnings call transcript, it's critically important. So let's be super clear on what book to bill means. Think of it like a restaurant. Bookings are the new reservations you're taking for next weekend. Billings are the people who just finished eating, paid their check, and walked out. If your book to bill is above 1, you're getting more new reservations than you have customers leaving. The future looks great. But a ratio below 1, which the CFO admits they had, means you're serving more customers from old reservations than you're taking in new ones. You're burning through your backlog, and the future pipeline of business is actually shrinking. It is a crucial leading indicator that future demand might be slowing down. So this forces us to ask the hard question, doesn't it? While the Q1 revenue numbers look amazing, they're a reflection of the past. They're the result of orders placed months ago. The book-to-bill ratio, on the other hand, gives us a sneak peek into the future. And a ratio below 1, even just slightly, suggests that the ground underneath all this incredible growth might be a little bit shaky. Is that blistering pace of new orders starting to cool off? The market is throwing a party for a quarter that's already in the rearview mirror, but this one little metric suggests we need to be very worried about the road ahead. It brings the sustainability of that 30% growth into very serious question. Now, let's pivot to the second area that's giving me pause, the automotive segment. As the analyst pointed out, this is not some tiny part of the business. It's a full quarter of ADI's revenue. So while the industrial and communications engines are firing on all cylinders, the automotive engine seems to be sputtering and sending some really contradictory signals. On the one hand, if you look at the annual growth, it seems okay. But when you zoom in on the more recent quarter-to-quarter trend, a much more troubling picture starts to emerge. And here is the contradiction laid bare. Year over year, the auto segment is up 8%. If you just looked at that, you'd say, hey, that's perfectly fine, healthy even. But the sequential number, which measures the change from last quarter to this quarter, shows an 8% decline. That is a sharp U-turn. Sequential growth is a much better indicator of what's happening right now. And right now, this huge segment is shrinking. It tells you that while the business is bigger than it was a year ago, its momentum has not only stopped it in its tracks, but it has sharply reversed in the most recent period. And listen, this isn't just my interpretation. Management came right out and acknowledged this weakness on the call. And management didn't even try to hide the issues here. And the reasons they gave are pretty concerning. They cited a tariff and macro pull and unwind, which is just corporate jargon for our customers in China bought a ton of our stuff early to get ahead of tariffs, and now they're sitting on a mountain of inventory and don't need to order more. They explicitly noted softer bookings specifically in this segment. They acknowledged having greater exposure to China than ever, a market that's facing huge economic headwinds and geopolitical risk. And to top it all off, they're guiding for the auto segment to be below seasonal again in the second quarter. This is not a one-quarter blip, folks. This is a collection of very real identified headwinds that are actively slamming the brakes on a quarter of their entire business. These are real cracks in the armor. Okay, the skeptic raises some very valid points. You can't just ignore a book-to-bill below 1, and that sequential decline in auto needs to be on every investor's dashboard. But I'm going to argue that these are minor stress fractures in the walls. They are not cracks in the fundamental bedrock of the company. And that bedrock, my friends, is ADI's unwavering, ironclad commitment to shareholder value through capital returns. In a market this volatile, this is what separates a good company from a truly great long-term investment. This number right here is the direct counterargument to every single point of fear. In the exact same quarter where management was admitting to softer auto bookings and a sub-1 book-to-bill, what did the board of directors do? They approved an 11% increase to the dividend. Just let that sink in for a moment. That is not the action of a management team that is scared about the future. That is a powerful, definitive statement of confidence. They're putting their money where their mouth is, and they're signaling to the market that they see any of these current headwinds as temporary and totally manageable, and that the long-term cash flow of this business remains incredibly strong. And this confidence isn't some new thing they just found. Let's walk through the history here, because it builds an ironclad case for their commitment. Step 1. They have now increased their dividend for 22 consecutive years. Think about that. That streak includes the 2008 financial crisis, the COVID pandemic, and multiple recessions. They always raise the payout. Step 2. Since they started this program back in 2004, they have returned over $32 billion to shareholders. That is an astronomical sum of money. It's more than the entire value of many companies in the S&P 500. Step 3. Since they made that game-changing acquisition of Maxim in 2021, they've returned over 100% of their free cash flow. They are not hoarding cash on the balance sheet, they are giving it back to the owners of the company. And step 4, in this quarter alone, they returned $1 billion. This consistency, this track record is the bedrock that long-term investors should be focused on. And here's the most crucial point. This is not a temporary tactic to prop up the stock. It is a stated, public, long-term policy. The company is on record, committing to return 100% of its free cash flow to shareholders. A policy like that acts as a powerful structural support for the stock price. It creates a baseline level of return for you, the investor. And it forces a powerful discipline on management. They have to focus only on the highest return projects, instead of wasting money on pet projects or empire building. It is the ultimate sign of a mature, confident, and incredibly shareholder-friendly company. So, it's time to bring it all home. On one side, we have the immense power of those growth engines, the exploding profitability, and a management team signaling supreme confidence with that dividend hike. On the other side, our skeptic has pointed out some very real-time indicators, like the book-to-bill, and clear headwinds in a major segment. It is time to weigh the strength of the fortress against those cracks in the foundation and arrive at our final verdict. Is Analog Devices built to last, or is it a trap waiting to be sprung? Let's lay it all out on the table. The bull case, the fortress, is built on that incredible 30% revenue growth and that jaw-dropping 103% jump in operating income. It's being powered by massive, broad-based strength in their core industrial segment and, of course, the huge secular tailwind of the AI build-out that's fueling the communications business. The entire structure is reinforced by that ironclad capital return program, highlighted by the 11% dividend hike and a very strong guide for Q2, which projects a new all-time high for the company. But the bear case, you just can't ignore it. That book-to-bill below 1 is a nagging concern about future demand. That 8% sequential drop in the critical automotive segment, a quarter of the business, is a real and present issue. And management has been totally transparent about the causes: heightened China exposure, tariff headwinds, softer bookings, and weak guidance for that specific segment. And of course, hanging over all of this is the general macro and geopolitical uncertainty that affects this entire industry. So, here is the final verdict from Iron Financial. This is not a trap. The financial fortress that Analog Devices has built is, in fact, solid. The core structure is absolutely sound. It's supported by the immense cash flows from industrial and communications, and it's anchored by that unwavering commitment to shareholder returns. However, this is not a blind buy. This fortress requires active monitoring. You need to keep it on a tight leash. The automotive wing, which is a significant part of the overall structure, is showing clear and undeniable signs of stress. Right now, the company's diverse strength is more than enough to handle these issues, but investors absolutely must watch the automotive segment and that overall book-to-bill ratio very, very closely in the coming quarters. And that leaves us with the one crucial question you need to be asking yourself going forward. Is ADI's automotive engine starting to sputter? The fortress is firing on its two biggest cylinders, industrial and communications, which are being pushed forward by that unstoppable wave of AI. How management navigates the slowdown in that third critical engine will ultimately determine if this fortress can continue to stand tall against the headwinds of a very challenging market. That's all for this explainer. Thanks for joining us here at Iron Financial.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.